This video reviews and examines summary of transactions for the company Net Solutions. Assets equals liabilities plus owner's equity. All transactions should keep this accounting equation balanced for each individual transactions, and then in total as a whole, assets in total equals liabilities plus owner's equity in total. Let's take a look at cash. It's typical cash will involve many transactions. Cash could increase or decrease. Increase from revenue, increase from capital, but decrease from drawing and decrease from spending on expenses or on investment of assets. For example, look at row B. $20,000 of cash was used to purchase land. Supplies, that's a prepaid expense. It's called prepaid expense, quote unquote expense, but it's an asset account. When it's purchased, the supplies balance increased by $13.50. However, it's really gonna stay there until it's used up, and when it's used up, it becomes an expense. For example, in row G, we see 800 of supplies was used up. And so 800 of the $13.50 was transferred from the asset supplies to supplies expense. The supplies account will have a balance from the purchase and then a decrease from the use of the supplies asset account. And then it gets replenished when more supplies is purchased. Land is a fixed asset. It's a huge investment. So there won't be many transactions. In this case, there's only one. Other fixed assets could be equipment, building, machinery. Liabilities, there's one account that we learned in this chapter, that's accounts payable. There would be a number of transactions of accounts payable from purchasing supplies, purchasing inventory, or having expenses incurred but not yet paid, and so it's posted to accounts payable. It's an obligation that will be paid out in the future. It's not paid in this period, and so it's a liability in this period. It's recorded to accounts payable account. Something was purchased on account, but that account balance will be reduced when it gets paid by cash in the future. Capital is a type of owner's equity account. When the owner or the shareholder puts money into the business, injecting funds so that the business could operate initially and ongoing when it needs additional funding. We see here that the owner, Chris Clark, injected $25,000 to start off the business. This account has only one direction. Anytime there's capital, it would increase the balance. On the other hand, the owner could withdraw money, and we see here in row H, $2,000 was withdrawn. Drawn account only have one direction. Anytime there's drawn, it would increase the drawn account, and more drawn would make the balance higher. But the drawn account has a negative impact on owner's equity. Therefore, it's shown as a negative number. The opposite of capital. Fees earned is a revenue account. It's from providing services to the customer, and because service was provided, revenue was earned, and it's recorded to the account fees earned. There would be many transactions involving fees earned because fees earned is a core business transaction type of account. That's how the company operates, is providing services to customers. We would see fees earned balance being one direction unless there's a refund of any fees earned. Opposite of fees earned are expenses. Expenses are the use of assets to generate revenue, to incur assets such as cash or use of supplies. companies incur expense and more expenses, and the balance of expenses would go up and up. On here we see expenses shown as a negative number because of its negative impact on owner's equity. The company operates by incurring expenses and earning revenue. Revenue, like fees earned, increases ownership, owner's equity. Expenses, on the other hand, decreases ownership, owner's equity. Here we are showing the impact on the accounting equation. Transactions are recorded into accounts. Accounts are classified based on assets, liabilities, or owner's equity. Each account and the related transactions have an impact on these three elements: assets, liabilities, and owner's equity. Each individual transactions should always be recorded in balance, and if each individual transactions are recorded in balance, in total, the accounting equation will also be in balance. Assets equals liabilities plus owner's equity.